Hi, Steffen. Thank you for taking the time to talk to me. I'm going to quickly introduce yourself. So, Steffen, you have a PhD in International Political Economy from City University, and you're currently a research group leader of the OBFA-TRANSFORM at the Global Climate Forum, and in cooperation with the Freie Universität Berlin.
Mm-hmm.
And briefly to myself, I'm currently a PhD candidate at the Darmstadt University of Applied Sciences. And the reason why we're having, or the motivation why we're having this conversation is the PhD thesis that you wrote, and that's sort of also here in the background. But before we get to it, maybe just as a sort of an introduction, how did you end up to become a researcher? Was it like you woke up one morning and said, okay, I'm going to become a researcher? Or how did that go?
So first of all, thank you for initiating this conversation. It's a pleasure to talk to you about the PhD thesis, which I wrote a couple of years ago. So I studied political science and economics back in the days in Munich. And I guess I always had it a bit as a virtue to write text and to figure things out. But I don't think that you really can say, okay, I want to be a researcher, and then it's also really not a career that you could plan. So I guess at some point you say, do I want to do a PhD? Maybe, maybe not. In the end, you start thinking about what could you do. You have ideas, you write like a proposal, you send it to places, you see if it resonates or not, and so it's a process, and you start, and then the question is if you can continue or at some point decide, no, I won't do it anymore. But in my case, I did a PhD, I did a couple of years of postdoc, and now I'm also really leading a research group. So
I remember reading in the PhD thesis of yours that I think your parents are also, or your father is also a researcher. Did that ever play any role?
He's not a researcher, but he did some research for some time indeed. I guess the what I said, the virtue that you like writing certainly has to do with it, and I guess an interest in politics and economics also comes with it.
Is there perhaps a memorable moment in your childhood, or you referenced, or you put more emphasis on your actual study times, where you remember and say, this could be something, and what moment could that be? Or what was
it? You mean for research in general?
Mm-hmm.
I think during school times at some point you have to write your Facharbeit, so the first small research paper, and I just really enjoyed that and thought this is something I like. And I guess I was always drawn a bit to text and producing text, and so spending my time on text. I guess this is just a general inclination maybe.
Right. So let's get to the actual thesis. It was named the Political Economy of Private Credit Money Accommodation. And if I were to summarize it, it gives a theory, an account on how the financial system evolves or transforms, I guess it's a better word. I'd like to go in trying to understand your thinking on this and your work on this in 7 parts. One, I want to go through the motivation, some of the research design. I want to speak a little bit about the literature review that you have referenced there. And then also the money view, which I think you take as a method to, or sort of an approach to understanding what is going on in the financial system. Your actual theory, and then spend also some time on the cases that you have selected. And then maybe at the end, speak a little bit about the conclusion of what that all has to tell us in how the financial system sort of transforms. So starting with the motivation, how did you end up picking that specific question or the questions that you answer?
So I mean, the thesis, I wrote it between 2013 and 2017. Now it's 2025, so that was 8 years ago. I started developing that proposal maybe in 2012, so it's been a while. During my studies, I got interested in questions of money and crises. There was a time of the global financial crisis. I was a student then, and then the Euro crisis happened, and I also wrote my magister thesis about the Euro crisis. And I studied how in the German discourse causality is constructed for the crisis. So how do they explain what actually happened? And I was interested in systematizing the ways how think tanks mainly said the Euro crisis happened. And I felt so there were some approaches that said it's just an exogenous shock. Others said, oh, we had good institutions like the Stability and Growth Pact, but it wasn't biting enough or something. And then there were the more fundamental critiques that said, maybe a monetary union cannot work like this. And I thought, yeah, that's interesting, but so how can a monetary union work? And how was it actually done in the past? And what is money in the first place? What did they actually change? And I felt that in everything I read, there was nothing really substantive about money. So money was always just somehow in the background, and it was also very ahistorical, right? So because I thought, isn't it the case that like 100 years ago something else was money? And so how did that change? And why do we have a monetary union now where money looks like this? And so I just felt very dissatisfied by the status quo of the discourse. And yeah, I felt both a historical angle, a theoretical angle on money, but also like a cutting edge angle of how the monetary system actually works, what actually went into crisis at the time. So this was all missing, right? So, and I guess that was my problematique, if you want. And then the first research proposals that I had were really hyper ambitious and said, oh, I want to like reconsider monetary theories, and I want to understand like all the evolution of money from the past until today. And I really want to look into those things that crashed in 2008 and then 2012 in the Euro crisis. And I also want to come up with better ideas for how to organize money in Europe. So that was basically my initial PhD proposal. And this is obviously way too ambitious and broad. And yeah, I sent it to I spent basically 1 year looking for a place where I could do this kind of research. And I was always in between disciplines with this, because if you really want to do monetary theory, the political scientists will say, well, this is not political science. But also for the economists at the time, that was really not a valid question, because they said, well, if you do a PhD in economics, you have to build DSGE models. That's basically it, right? So yeah, this time of thinking, this way of thinking and this way of asking questions, didn't sit well, I guess, with the established academic structures. And in the end, I found a position in the UK, because there's this field called international political economy, which is just more prone to seeing politics and economics in an integrated way, and that also really allows historical research, and that also is more open to different methodologies. So to say, well, there are different questions, and a particular question requires a particular methodology, so you have to understand which methodology to pick for your question. And yeah, this was then possible in the UK. And so I did this thesis from 2013 to 2017. And then also narrowed down the scope, right? So Europe doesn't play a role in it. It's really about the UK and the US. And yeah, it took me some time to be able to really reconcile all those interests, monetary theory, monetary history, and then also cutting edge stuff, but in a very different way than I thought originally it would look, right? But yeah, that's the process of doing a PhD.
I found it interesting that you said that you really started perhaps even in Germany, but definitely sort of in a European setup, and then reading the thesis, it's become sort of a global approach, or how you said, sort of a UK USA approach. When did that sort of when was the epiphany where you said, okay, this is something which needs to be set up in a different geography, or I don't even know how to say it, and what made you understand that? Was there a moment? Or?
It's not really an epiphany, because I also have to say that I continued working on Europe, but I just shifted it to my postdoc years.
Yes, you published on that.
Yeah. I mean, I then did like several years of postdocs also in the US, where I actually worked on Europe. But I think the point was simply it's writing a book more or less, and you have to frame it in a way that you say you have a theory, and or you have a question, then you need to do a literature review, a theory, and then provide cases that somehow contribute to answering the research question that you have, which means you just have to mold it and see what can you actually put in, what do you not want to put in, and then once you embark on the PhD voyage, you just realize how much is out there that you didn't know about while you were preparing your proposal. And yeah, then I guess it was just a process of continuous reflection, getting feedback, where you just try to find a way how the whole thing can work as a consistent piece. And yeah, so at some point I think relatively early on I decided that this is just too much to focus on Europe. And I guess in the first year of the PhD, I really got to know the literature about shadow banking. I didn't really know shadow banking before that. My supervisor in London, she had published a lot about shadow banking. So I read about this, and when it came to the story about how money as an institution transforms, I thought, yeah, there's also a money story in the shadow banking literature, and I wanted to focus on that. So don't we see here new forms of money, or at least like forms of money in their infancy? And yeah, I decided to put this question in center stage in the PhD thesis, and yeah, combine this. So this idea that maybe in the late 20th, early 21st century, there has been a change in what we consider money. And is it the first time that this happened? No, it also has happened in the past in a comparable, not identical, but still comparable way, and trying to carve out this process, to isolate this process and say, hey, this is a recurring phenomenon, and then there's a certain logic to it.
Perhaps that's a good segue to go into sort of the research design. And before we go into the details there, because you referenced sort of a piece by Jackson in 2011, I'm just curious, how did you and when did you get to read the piece? Is that something that was relatively early, relatively late? Was someone pointing you in that direction? Is that something that was an obvious one to consult?
So this Jackson book is written basically for PhD students or researchers in international relations, and it's a call for methodological pluralism. And the way I read it is that it mainly addresses positivist researchers. So the idea of positivism is that the typical question is approach in positivism is that you take a data set and then you throw some methods on it, and you want to, isolate causal connections about two phenomena that you observe, right? And I think the point of Jackson is to say, hey, there are centuries, if not millennia, of human history where we were discussing how can we actually generate knowledge. And then he provides a rather simplified approach to say, hey, there's not the one correct thing, right? There are different ways of doing it, and there's maybe a methodology that for the last couple of decades has been rather dominant, and it's good to answer some questions, but there are also a lot of other questions that you cannot respond to with this approach. And I felt the need to say, hey, I do not want to do positivist research, and at some point I thought this could be a good way of legitimizing and explaining what I do also to people who have more been working in a positivist framework. And so it's not that the things that Jackson discussed I hadn't heard before. I also studied philosophy. So the question of how to generate knowledge and what can we know, what is the relationship between me and the stuff that I observe, I've been discussing that. We've been talking about this a lot prior to doing the PhD, but I felt this was a rather convenient way to establish that at the beginning of the thesis, to say, hey, this is not a positivist research, so please don't judge me on that grounds, but it's an approach to try to make sense of historical transformations and develop an ideal type, an ideal typical movement, and then show how this is reflected in different historical episodes.
Well, that's a really interesting answer, because you just mentioned that you had read which I think you just called philosophy, or like what can be known, and sort of, I think in science speak sometimes called sort of what is epistemology and what is deontology, that you've gotten to know this prior even your PhD thesis. And I'm just starting on my PhD thesis, and I've more through luck I've gotten my hands on this piece of knowledge, if I may say it that way. But I find it sometimes so interesting that people who don't deal much with it, or who do, makes a tremendous difference in how you approach your research, and that you had an early opportunity or luck, or maybe it was a processed way of getting access to it. I think it's a very positive thing. You mentioned in your thesis sort of the difference between, if I'm correctly, sort of international political economy, more British style or American style, and I think yours is sort of more in the British style, specifically as you mentioned Jackson calling for a pluralistic approach and sort of on what level the questions are being answered. Can you talk a little bit about these two subgroups of international political economy?
Yes, I mean, that was a debate maybe 10, 20 years ago, and some say the distinction between British and American IP doesn't really work, others say it does. I decided to just use it. I mean, it's a bit of flashy antagonism. So the idea of American IP is that you say you basically do mid-level theory, where you take a data set and you try to identify causality for certain research questions. So this is basically a positivist approach, very often a rational choice framework, where you say, there are like in economics, right? So there are rational utility maximizers, and we try to explain phenomena that we observe based on how they showed optimizing behavior or something like this. So those are the typical research designs of American IPE. And then British IPE is more prone to historical approaches, maybe to grand theories. So you would talk about capitalism and capitalist development. But then one criticism you have towards this is that you say, it's more ideological or it's normative, and the other approach is to say, well, it's just methodologically rather weak, so it's not a hard science approach, so you don't really go into the data and analyze with econometric methods what you want to find out, but it's much more, it's establishing a narrative, a story. I guess maybe British IPE would say about American IPE that most of the questions they answer are a bit simplistic and maybe not that interesting. And so I guess this is just one way of framing these ongoing debates on how you can actually generate knowledge and how you should do science.
Thank you. That's helpful. So let's talk about Jackson. And he sort of designs how I would understand the different epistemologies sort of in a matrix. And sort of on one side, it's the relationship between the knowledge and the observation on one side, one axis, and the other one is the relationship between the knower and the known. Can you fill us in a little bit what that means then for the different researches that you can do according to him?
Yeah, I guess the first dimension is just to ask what's the relationship between me or the observer and then the world out there that you're analyzing. And the question is if you can have the assumption that there is really in German you say das Ding an sich, the world itself out there that you can just need to explore. And then the whole way how you frame the approach is to say, there's me, but I might be biased, but there's the world out there, and I want to really understand what's in the world, but then I have maybe some things may distort how I perceive the world, and so I have to really make sure that I get an objective representation of the world out there, maybe in data, and then I do, for instance, causal analysis to see if the causality really exists in the world out there, or if I have a wrong projection. But so the idea of the mind-world dualism, which is the first distinction, is to say, there is the stable world out there, and the goal is to recognize it, to understand what's going on there. And that my mind-world monism, I think it is, right, says there may be this world, but we can never know, right? It's a bit futile to believe that you could ever generate knowledge about the world, how it really is independently of me. So this is maybe a bit of a naive assumption, right? So we cannot go beyond our own biases. And so, as I said, I did philosophy also before doing my PhD, and so I think I wrote one thesis on the critique of pure reason of Kant. So, and he talks about the transcendental idealist and the transcendental realist. So the transcendental realist thinks that you can actually, that there is this stable world out there and you should recognize it. And the transcendental idealist thinks, well, that doesn't work. And I clearly adopted the position of transcendental idealism there. That's why I say, okay, I do not need all the instruments that the positivist approaches have, and so that puts you then in the second camp that is often called interpretivist. And I decided to use Jackson to basically establish that at the beginning of the thesis, and which puts then the whole approach pretty firmly into the camp of British IPE, if you want.
Okay, so in mind world dualism, it's there's a real world, and me knowing about it is not going to change the fact about any of it. And
I guess dualism says there is this real world, and in principle we can recognize it if only we overcome the obstacles.
Okay. And the monoism is definitely something that's more constructed. I think you mentioned that with
it says that it may be there, but we will never overcome the obstacles. So there will always be traces of ourselves and us as the observers in there.
And okay, fine. And then of course then is the relationship between the knowledge and the observation. I think so. He makes these 4 fields where it sort of says neopositivism, critical realism, and then sort of analyticism and reflexivity. You position your research in analyticism. But before we go there, as a brief question to reflexivity. In sort of my understanding, this is a field that's rather newer, or it's being discussed more recently, a lot more. How do you try to describe the reflexivity field?
I'm really not sure if it's so much newer. I mean, it's I don't know, isn't it the Descartes approach, who wants to be sure about what's out there, and then just finds that the only thing you really can know is about the self. So I think this notion of reflexivity is not particularly new at all, but I think that we're talking now about the second cleavage, right? And the way Jackson frames it is that he says, okay, if we now do research either in the dualist or the monist perspective, do we just focus on what we can observe, or do we have to look for stuff that's beyond what we can observe? And he says that this problem exists both in the positivist and in the interpretivist camp. And in the interpretivist camp, then you would say, if you just say, okay, I analyze so I get data, historical data about events, about transformations. So can I take them at face value? Or do I even have to go further and also say, I observe this, but then I also start questioning myself, and I start reflecting about me as the observer and challenging the things that I observed and ask if I maybe misinterpret something. So it's much more a self-reflexive approach, which you maybe can find in post-structuralist research. And I didn't do that in the PhD thesis. That's why I, at the end of the day, said, okay, so this is analyticism according to the labels that Jackson introduces. Maybe not the most straightforward label you can choose, but I thought, okay, just to legitimize the type of approach that I do in the PhD thesis, it makes sense to work with Jackson and use his labels. And then he says, I think he says at the end of the day, it's social science in the tradition of Max Weber or something. And then, this would be another way of framing it. But in particular to the positivists, I thought it was helpful to rationalize these debates with this 2x2 matrix.
So when I dealt with this matrix or this categorization, I was wondering if reflexivity also means a certain way that, there's a development in how we perceive, and there's sort of a development in our mind. And I was wondering, if so, how perhaps an understanding of money could have been different of a researcher doing research in the 1800s and then someone doing it today. Is that something that resonates with you as an idea that you see, yeah, I mean, there could be something, or I don't know.
Maybe what you're pointing to is just history of economic thought, that you basically trace the development of theories and how thinkers at different times have different ideas of what money is. I mean, yeah, clearly, I mean, this is obviously a possible approach, and I think the thesis also has a discussion about history of monetary thought and comparing different ways of thinking about it, but I do not trace it. So I guess I then say in a later chapter, okay, no, here, this is my conceptual framework about money, and yeah, I guess the whole thing could have become reflexive if I then also had questioned my own monetary theory in that thesis and say, yeah, okay, I said this now, but maybe this is also wrong because I had biases here or something.
Let's move then to analyticism, which is, according to this matrix, is things that you can observe, and it's sort of in a mind-world monism, sort of in a constructed world. I would put it, let me know if that's not entirely correct. Can you briefly talk about your approach in analyticism when it came to this work?
So what the thesis does, by and large, is to ask what's the role of the state in the monetary system, and then often there's this idea of fiat money, which can be operationalized in different ways, but one way would be to say, well, at some point the state was in the position to decide by decree that a certain instrument should be money. So that's the moment of fiat. And that also the state then creates this money. And I basically try to argue against that and provide, in that sense, a revisionist theory of the role of the state in the, at least, capitalist monetary system. And the story is that the instruments that we use as state money today emerged as private credit money, or just private credit instruments that then turned into money. Maybe there were shadow money at some point, and then they became bigger and more important, and at some point they entered into a crisis, and then the state came and backstopped them, bailed them out, pulled them under its control, and the label chosen for that is private credit money accommodation. So the story is that the state is a latecomer when it comes to monetary instruments, and yeah, the state didn't decide, it never had the power to rule by decree that a certain instrument should be money, but that those were endogenous developments, maybe largely driven by private financial entrepreneurs, and then the state just grabbed it. And this phenomenon that I describe is sort of the ideal type, and then what the thesis does is first explain this ideal type in general terms, and then apply to 3 different cases that then explain why the public monetary system today looks the way it does. And it is analyticism because I think it's this ideal typical movement that I tried to describe, unveil, and then show how it happened in a complex reality in the past.
Okay, so let's move on maybe to the literature review that you've done in this work of yours. And I would say that irrespective of the lens or this school of thoughts that you introduce, you claim or write that there's sometimes they have the same bias in both schools, or some schools are more prone to others to the so-called essentialist or chartalist bias. And you kind of say that might come from sort of pre-modern times when these schools were sort of all established. Can you talk about this a little bit more?
Yes, I mean, as I said, the motivation for the PhD was also some dissatisfaction with the underlying monetary theories in the established analyses of economics, of political science, and of political economy. And I was looking for labels, for ways to express this dissatisfaction, and I ended up framing this through these two biases. The essentialist bias says that in fact, we live in a credit money system, so that is the general assumption, right? So all the monetary instruments that we deal with are credit instruments that are the liabilities of some institutions or persons and the assets of others. So there's always this asset liability structure, and it is based on credit creation out of nothing. But the labels that we tend to use about money and how the monetary system works, how it operates, how it has been operating, is really informed more by commodity money theory, so by pre-modern logics that just does not take the credit nature of modern money seriously. And so I called it essentialist because, it seems there's an essence, so a real thing underlying the monetary instruments that we use. I remember one of my textbooks about the Euro crisis just used the specie flow mechanism by Hume to explain how the Eurozone works and what the Euro crisis was. And so this is about gold flowing in between countries. And so it somehow assumes that there is really a commodity money underlying the monetary system that we have. And I felt that this is just fundamentally misleading on a monetary theory level of how we think about the political economy of modern money. So that was the one bias. And the other bias is, I call it the cartelist bias. So this is about the relationship of the private sector and the state when it comes to the monetary system. And well, as I said, the story of the PhD thesis is that the monetary instruments that we use as money today have largely been developed through private initiative, private financial engineering in times of big industrial change. And then they became more widespread, and at some point they were accommodated by the state, which means that there's a priority of the private sector when it comes to developing new money forms, and the state is a latecomer. Whereas cartelism assumes that, well, states have the ability and also have done that in the past, that they just rule by decree what money is. I thought that this was misleading. So when I tried to construct also the research gap that I'm addressing, then I said, no, we have to rethink the role of the state in relation to the modern credit money system. It's not the first mover like cartelism suggests, but it's really the latecomer.
Right. And I think you go about and saying that these two biases in between, there's sort of the blank spot, or there's sort of the white spot in which you are trying to now to fill in.
So I used the second I introduced the second 2x2 matrix in the thesis that was then on monetary theories, and I said, there are basically two big cleavages. One cleavage is called monetary theories of credit versus credit theories of money. This is something that Joseph Schumpeter had developed, or like an antagonism that I found very useful. So monetary theories of credit assume that there first has to be some monetary instrument like gold nugget, whatever, and then credit is built on top of that, so it's logically secondary. So you already have the monetary instrument, and then you lend it out, and this is how credit comes into play. But first comes the monetary instrument, and credit is built around it. And then credit theories of money say, no, it works the opposite. So we can owe each other, which we can, we can establish a credit relationship, and we can only verbalize this, right? But then we can also formalize it. We can introduce some bookkeeping mechanism, or we can also write physical IOUs, debt instruments that we can circulate. So the debt comes first, and then some of these forms of debt can be used actually to make, for instance, payments, or to actually circulate, what the gold nuggets would be in this other framing, right? And so, those are two antagonistic ways of thinking about money. But the assumption that I adopt in this thesis is that it's much more promising to understand our modern monetary system if we assume the credit theory of money rather than a monetary theory of credit. And if you believe in a monetary theory of credit, which I think most people do and most research did that I reviewed, so then you are like prone to this essentialist bias.
So most believe in
a monetary theory of credit. That money is primarily a thing and credit is built on top of that. So as I said, I constructed 2x2 matrix that says, okay, monetary theories of credit versus credit theories of money. And then the other cleavage is to say whether the state has priority in determining what money is or whether the private sector has priority. And
that's state-based and that's market-based.
That's state-based versus market-based. So, which then leads to the situation that you can have state-based monetary theories of credit, market-based monetary theories of credit, state-based credit theories of money, and market-based credit theories of money. And I then, so you define those for options, and then I try to fill this with life and give examples for each of those four possibilities.
Let's maybe start with the monetary theory of money.
Exactly, and so there's the classical debate at around 1900 between metallism and cartelism. Metallism, then the usual example is Karl Menger, an Austrian economist. Cartelism is Knapp, a German, I think, lawyer actually. And yeah, if you look into textbooks, then there's a lot of debate about, well, metalist or cartelist money, which I guess made sense at the time, even back then most of the international money, I guess, was credit already in the sterling system. But yeah, the framing was very much in a monetary theory of credit world and subject to what I would call the essentialist bias. So I just acknowledge this antagonism, this historical antagonism, rather briefly. And then I say the same thing is actually going on in the world of credit theories of money, and the juxtaposition that I make is between modern monetary theory as a state-based credit theory of money, and then Perry Merling's money view, which is a market-based credit theory of money. And so this passage I wrote during like an exchange term at Columbia University, so that was in 2015. So, and those were just debates that were going on there at the time, right? So there were the MMT group, there was a money view group, and I thought this could be a nice framing of showing the different approaches of the relation of the state to the credit money system. And I really needed that as the theoretical apparatus, because what I actually wanted to make later, I wanted to make the case that money, or new forms of money, develop in the private sector and then get accommodated by the state. So the logical priority of the market over the state historically was an important thing to establish.
Right. So I think so we are now within the credit theory of money and state-based credit theory of money. You call that sort of neo-chartalism, and as you just mentioned already, sort of MMT is a very known and much discussed way of thinking about money, and in our case, the innovation of the financial system, or how it perhaps should innovate. Why are you not picking MMT as or let's say state-based credit theory of money as a way to explain the innovation in the financial system?
So in my understanding, both MMT and the money view are interpretations of the work of Hyman Minsky and also Josef Schumpeter. So there's a very similar lineage, and I guess this idea that I draw upon all the time, that the monetary system is a web of interlocking balance sheets and money is credit instruments that circulate in there. I think both of those theories can agree on this. So I think there are actually a lot of similarities between MMT and money view, but then the big differences were how to interpret basically state money or central bank issued money and what to make out of the shadow banking system. And I think the MMT, if you read MMT literature, they mostly would say that the state, so the central bank is the state, and through the central bank, the state provides monetary instruments to the financial system, and this is a form of outside money. And then the argument of the money view is that the central bank is also just one form of a bank, and that central bank money, be it banknotes or central bank reserves, is also just a form of endogenous money creation. It follows the logic of credit money creation, and it's a very special form of credit at the apex of the hierarchy. And this distinction is just important, as I keep on saying, for the research, because the question is, how is it that the state gets into control of certain monetary instruments? And if you have this latecomer theory that I have, then it makes much more sense to interpret central bank money the way the money view does, rather than what MMT does. Even though this is a story about genealogy, and then at the end of the day, when it comes to describing the system as it is, the difference may not be that big anymore. And the second point is how to assess the shadow banking system. So there was a big debate about shadow banking. Shadow banking lay at the heart of the global financial crisis, 2007 to 9. So it created financial instability. It was certainly fraudulent. It's certainly, those are financial structures that create problems. So maybe it would be better to regulate them, or if they wouldn't exist or something. But I guess the MMT approach is to adopt a rather normative position to it and says, yeah, this is just an error. And I guess the money view position is much more institutionalist, and to say, well, this has developed, it has developed for a reason. And to just say on normative grounds, I don't like it, maybe doesn't lead you so far in trying to actually understand this phenomenon. And I found this idea of a shadow banking system, of shadow monies, of credit instruments that substitute the existing money supply. I found this very interesting. And so my approach to this in the thesis is to say, well, this is a phenomenon that has just always been there, right? Even if you go back to the 18th century, you find financial structures that you could call a shadow banking system, and you find private credit instruments that you could call shadow money. And there's just a logic behind it, right? You have sort of the regulated system, and then you have the unregulated system, and there will always be an incentive for financial engineers to create new money substitutes. And if we want to understand how it happened that the state controls certain instruments, then you have to look at shadow money structures of the past and say, okay, they were just a fact of the age. And some of these shadow money instruments then actually became systemically relevant and eventually were then grabbed by the state. And they are what we call or consider normal state money today. So it also gets normalized, but out of a shadow money logic historically.
Is it fair to say that MMT has more sort of a top-down approach? You talked about the apex where the expansion happens, and the money view, or sort of the market base is sort of more bottom-up. And then when you just mentioned the 1800s or so forth, that it seemed to you, at least looking at the literature, or let's say the events that happened, that it was more of a bottom-up story than a top-down story. So
yeah, I think this is a very good way of framing it. So I guess both MMT and money view can agree on hierarchy. There's a hierarchy of, say, institutions, could be the central banks, and then non-bank financial institutions or shadow banks. And the logic of a top-down approach is to say, well, the hierarchically highest institution creates money, and then maybe the hierarchically lower institutions use this as reserves, for instance, to then again build credit on top of that. And the reverse logic is bottom-up, where you say, no, money is created, for instance, on the level of banks through endogenous money creation. When you hand out loans, then you create deposits, and then you can trade on these deposits. And then it can also happen that the balance sheet at the top of the hierarchy expands, so that there happens a lot of money creation in the form of central bank reserves. But this is really a sign of stress in the system. So only if there's something wrong further down in the hierarchy, you actually have to escalate upwards in that sense, again, the hierarchically higher institutions are latecomers, are last resort institutions, and are not the first resort for money creation.
Right. That was helpful. Let's go now into the attributes of the money view and how you use them, or we're going to talk about how you use them to come up to your theory. So money view is a market-based theory of money. There's sort of four attributes that you work with. Can you talk a little bit about them?
Yes. So as you mentioned, so this is then largely the work of Perry Merling that I draw upon, and as you said, he is, I think, writing this down now. At the time, it was largely existing in his course, which he did at Columbia and then filmed as a MOOC. So this is all just sort of condensing, I guess, existing thoughts. But I found that these four elements that he used were very helpful as the monetary theory concepts to then build the accommodation theory. And I think the first one is the logic of endogenous money creation. I think it's called the alchemy of banking, or money creation as a swap of IOUs. So it's the idea that in order to create money as a credit instrument, what you need to have two counterparties, and they both expand their balance sheets on both sides simultaneously and reciprocally lend to each other. And then, so this is how you just create out of nothing a bunch of IOUs, and some of them can then potentially start to circulate, and you would then call them money. So this is this idea of the credit theory of money. So, and the structure of a swap of IOUs between two balance sheets is really what I'm looking at, or what I'm tracing also in the thesis across different instruments and across different historical periods. So this is maybe the first and maybe the most important assumption. And the second one is hierarchy, that you say there are. So the hierarchy both applies to institutions and to instruments. So there's a hierarchy of institutions, which I already mentioned, the central bank, banks, shadow banks, and then instruments could be reserves and deposits. Deposits are constructed as promises to pay reserves. This is how you can escalate upwards in the hierarchy. And then you have various shadow money forms, say money market fund shares. They're constructed as promises to pay deposits. So yeah, this is this hierarchical layering. And then the central bank usually guarantees banks, so offers like liquidity insurance, and then banks typically offer liquidity insurances to some forms of shadow banks, like special purpose vehicles.
Right. And there's maybe a few other attributes, but is it fair to say, to summarize, sort of when you take this lens of this money view or this market-based theory, credit theory of money, that it's sort of one big network that sort of has interdependence with each other, and there's sort of nodes that sort of do upper and lower hierarchy, but it's sort of, you approach it as this sort of, there's no difference between money and credit. It's one big network, so to say, that's hanging together.
Yeah, and this is really the assumption. What we're studying when we're studying money is actually a complex web of interlocking balance sheets and the credit relations that exist within it, which then maybe leads us to the third conceptual attribute, which is the hybridity, which you already mentioned as well, right? So that it doesn't help. So the idea here, in my translations, it doesn't help to think in binary categories between public and private, the state and the market, or so on, but that instruments and institutions can, I mean, you can have ideal types that are only public, and you can have ideal types that are only private, but in reality, a lot of institutions are somehow mixed types between the state and the market, or public and private. And yeah, if you look at the US, then the central bank, the Federal Reserve, is privately owned, right? So, which is then always like one of those standard arguments to say, maybe the Fed is not actually only the state, but yeah, it's also a hybrid entity. But then banks are private, but they are regulated in various ways by the state, and they have to comply with a lot of stipulations provided by the state. So, and they get certain privileges. So yeah, it's also not that they're completely separated from the state.
Right, but do you mean to say that in the US that the Federal Reserve System, that's sort of the the Bank of Governors is sort of, to the point to hybridity, how the state of governors is sort of controlled by the government, but the reserve banks, I think 12 or so, they are privately owned. And sort of
no, I think also, okay, true. But I mean, the board is politically appointed, but it doesn't really have its own balance sheet, right? So all the 12 Federal Reserve banks, which actually do the money creation and do the activities, are formally owned by the bank. So it's really a construct that has been planted into the American financial system at the beginning of the 20th century that is hybrid, yeah.
Right. Just because you mentioned MOOC, this was, I think, published in 2013. I think that's available online. Just maybe one last question sort of on the money view. So when you sort of deal with the money view and you study it, as you have, and I've looked into it, it's clear, of course, also as you just explained it and described it, that there is sort of this bottom up and there's sort of a hybridity in which both sort of the private actor and the state actor have a role to play in order to make, in our case, or in your case now, explain the innovation in the financial system. But I wonder, as a proposition to you, that the private actors still seem to have like a predominant role in this, and maybe not. And so the question to you is, how do you respond when someone says that sort of even money view still represents sort of more an essentialist bias? An essentialist bias understood as sort of the individual, the markets, at the bottom up playing the bigger role.
But the essentialist bias is about credit theory versus monetary theory of credit. So,
okay.
And so the essentialist bias really is not there in the money view. This is a clear credit theory of money. So that doesn't happen.
Right. And okay, well, let me rephrase the question. When we refer to money view as being a sort of a hybridity, being a key concept in that, to what does one outweigh the other? To what degree does the, let's say, the private actors play an outsized role vis-a-vis the state actors? Some would say that because, and we come to this, to really the core of it, your theory is the credit needs to become sort of systemically relevant. And then you could propose that is really almost forcing the hand, and therefore what is the role of the state or the public to then actually do? You could argue now maybe that it has to be systemically relevant, but now I'm already answering. Sort of, how do you? Sorry about this. How do you go about the sort of the proposition that it's more tweaked towards, in this case, sort of the private actors? Is that
so
fair? Is it not fair?
It's fair. I mean, I also haven't mentioned the fourth point of the money view yet, but to respond to your question, I guess I do not claim that I can say what the money view is, because that's Perry Merley's label and he has his take on it, and I abstract from a lot of things. So he worries very much about price, how prices are generated, and this is something that I do not look at all, right? I'm interested really in a political economy take on it. It's my interpretation of some aspects of it, and I would also say that that because it's just not his problem, usually the conceptualization of the state in there is marginal, let's put it this way, and I think traditionally he mainly looked at the US, and the US is also a bit of a special case, right? So a very, very young state based on colonies that gained independence at a already very quite developed stage of capitalism, if you want, right? And I don't know, I think that as soon as you look at different states, the role of state money will be maybe a bit different, right? So I think it's really the role between the state and the private sector, we can say maybe is a story of co-evolution. Private sector evolves. So what I like is to say that also the modern state is basically a creature of credit money, of monetary evolution, right? So the fact that we can issue debt in such large volumes, but also a lot of state power is just connected to the fact that you can control the credit system. But again, the state was not able to just invented by itself or ruled by a decree that this should exist. So I think at the end of the day, we are always in a complex relationship between states and private sector in the transformation of monetary systems, but this does not go against the general claim of the thesis that the particular instruments that we use as state money today were originally created as private money. So the state did not come up with them in the first place, but grabbed them throughout major crises. And so these major crises, maybe to make this point, this is now really the fourth point also of the money view, which I think is very important also for the story, that is that the credit systems are inherently unstable. So you create credit, and this is always it's a loan, it's a promise to repay something at some future point in time, and then if you can't repay, maybe you get another loan, so there are ways of rolling debt over and so on. But you just have this recurring tendencies that at some point there can be a moment when it all flips and you're not able to repay the debts, and then the system enters from a phase of financial expansion to a phase of financial contraction. And these phases of contractions are also very important analytically to explain how the whole system transforms, right? So in phases of financial expansion, you have financial innovation, and when the contraction comes in, then the whole thing can just shrink, implode, unless somebody is able to still pull it out of the mud, so to speak. And this is then always just the state entities that can do this, at least in the theory. So the assumption that a credit money system is inherently unstable is also really, it's important. And I don't know, maybe it's self-evident, but I guess in mainstream economics and so on, you don't have this idea of inherent instability, right? You look for equilibria, and that there's something, if there's a crisis, it has to be usually reconstructed as an exogenous shock. Yeah, so this endogenous instability is really a core assumption to approach the whole thing.
So we have been talking now for perhaps an hour or so to get really to the theory that you have constructed. And there's lots to talk about this. So why don't you lead us into and explain the theory that you have at the core of your thesis?
I think I alluded to it already a couple of times, but it's fairly straightforward. So I ended up saying, okay, there's a two-phase model. The first phase explains how a new credit instrument emerges that starts becoming a substitute for existing forms of money, and then also becomes systemically relevant in the sense that it gets so everybody uses it, it gets widespread, and if it was to disappear, it would lead to systemic instability. That's the first phase, and you can trace then in different cases how this happens, how new credit instruments in these phases of financial expansion are generated. And then the second phase is that once the flipping point comes, the flipping point, and a crisis hits, then the question is, can we let the credit network implode, or will somebody come in and backstop it? And the second phase is then called the accommodation of private credit money. And it refers to instances when then states came and decided to backstop private instruments, and I don't know, you can even call it nationalize it. I decided not to call it this way, but just to accommodate them into the public money supply. And then they suddenly have a lot of power, because then they now can control in one way or another the creation of these financial instruments, and then they start to regulate it, to use it more, to build something with it, right? But it's really the crisis-driven intervention that puts the state into the driver's seat with regard to this instrument.
Right, so you sort of now gone a little bit into detail of these two phases. So they're sort of build up, then you have sort of the turning point, and then there's sort of sliding down. You divide each of those two phases in three steps. Can you can we go through them one more time? You've kind of already talked a little about.
Yes, that, analytically speaking, I say that when it builds up, then somebody has to innovate and come up with a new instrument. that
short term, right?
Yes.
Is that important?
Well, it's the description of the swap of IOUs, which is a short-term IOU and a longer-term IOU. So you can say the deposit and the loan, or the short-term banknote and the loan, or it could also be a bond that is the counter, that is a longer-term IOU. But yeah, so you have a swap of IOUs. So I was looking for this balance sheet operation, right? That this takes place. And
that's just about right now at two actors. It's not. I think the next phase you make a point of it. Now you have to make the next phase would be to make these IOUs accessible to real money. Is that correct?
Yeah, I mean, I don't usually use the term real money because what is the real money? But so it means you have already a sort of a network of money. It can even be commodity money, right? But you now you start putting in a new hierarchical layer below it by just creating an IOU that promises to pay a hierarchically higher instrument, be it credit money or commodity money. And you have a lot of IOUs that can promise this. The very specific feature, which is also then a money view concept, is that it establishes par or something, or approximates par, which means that it maintains more or less a one-to-one relationship. So your shadow instrument, people start expecting over time that the shadow instrument will just trade one-to-one to the regular instrument, or that the fluctuations are relatively marginal, because then it really turns into a substitute, right? So then you start thinking, oh, this new instrument is basically as good as the old one or so, but maybe it's easier to get. Maybe you get a loan in this new instrument, but not in the older one, right? So, and yes, in that sense, the new instrument becomes more and more a substitute, and you can then also, in a credit theory of money logic, maybe call it money. And then the third step is that it's not only like a very marginal phenomenon that this exists, but that the entire monetary and financial system starts to rely on that, and that this becomes really normalized, that people use this. And yeah, I think also the evolution of these new instruments is also connected to phases of large economic expansion. So it's not a coincidence that the first real shadow money case, which I discussed, which is banknotes, is connected to the Industrial Revolution in the UK. So part of the Industrial Revolution was that you managed to create new credit instruments that allowed large-scale investments and transformations, and that then also started circulating. And yeah, through the Industrial Revolution, also the institutions of the monetary system changed. And you ended up having then these new instruments becoming systemically relevant, if you want, right? And people, firms use them until the moment comes when then somehow they stop believing in it and say, okay, well, maybe I had this shadow money instrument, but now I want the other one back. And then you get into this classical bank run situation where not everybody can get hierarchically higher money at once. And then you get like financial panics, and then
let's talk about this separately, because I want to also spend some time on it. But before this bank run happens, you also make a point. It needs to be systemically relevant. So it needs to have, let's just say, it needs to have a certain size. It needs to have sort of, if there's a run, it needs to hurt. Or how would you talk about systemic relevance?
I think I looked at the definition it's okay. Systemic relevance is maybe more of an opinion than an analytical, a clear-cut analytical category. There are dimensions if an instrument is systemically relevant or not, and yeah, that's the volume and then interconnectedness. So there are a few indicators that you can give, but at the end of the day, I think it is more of an opinion. So we need to rescue this because it's systemically relevant, because we do not want to risk a situation where this fails entirely.
Right. You mentioned as a reference sort of the industrialization in Britain, but you also make a point in your thesis that so let's say you have these IOUs, you begin sort of two parties exchange these IOUs, then you make them transferable into sort of whatever the circulation of credit is in the economy. That's step 2, and step 3, it has to become so big that it becomes systemically relevant. And it's all really the private actor that is sort of driving this story in sort of phase 1. And you make a point in your thesis, in your writing, that whilst this can happen through real world expansion, it doesn't have to. Can you talk a little bit about that?
I want to just add one small qualification to your original statement. I think it is driven by the private sector, but then it's not happening completely in isolation of the public sector. I guess if the public sector wanted to prohibit that, they probably could, right? And in many instances, then those private financial engineers seek reassurance from the public that they actually allow this and that this is fine, and maybe they even want guarantees that in case something goes wrong with it, the state would help. So it's, again, I don't think it makes sense to think of this as a pure dichotomy, right? But it's still the question who is in the driver's seat, sort of.
That's an important qualification, yeah.
Yeah.
And that also is a sort of a pointer towards this hybridity and also how this is not a pure private actor story.
Yeah.
But the point you make the point that it doesn't have to be with the real economy expansion, this sort of creation of of these IOUs. Can you expand on that?
Yeah, I mean the balance sheet operation that you need to create endogenous credit money does not involve anything that does not involve a transaction of a good, right? So it's a pure financial operation, and in that sense, there's also priority to. I think in a capitalist credit money system, I don't say that it always worked like this. I think the defining feature of capitalism is that you get this developed credit system and that you allow private credit money creation, right? Because then you're able to generate decentralized purchasing power that allows actually big investments and innovations to take place, right? So I think it is very, very specific to capitalism that you have this type of monetary system. But it also means that it is at least logically separated from real transactions. I mean, then in practice, would a bank that wants to survive in the future give a loan like this to an activity where you have no actual commodity, no actual production happening?
Maybe
no.
Less so.
So it certainly informs the rationale, but it is not a strict technical necessity. I guess that's the point. And right. that argues against the essentialist bias, where you tend to think, but it has to be somehow connected back to commodities or gold or whatever. No, it's not.
In a way, and this is might not be the only reason, but one reason could be that there's sort of speculation in where there is anticipated real economy expansion, and this is sort of, you just alluded that when you said that you do, what did you just say? Decentralized financing of something that might come or so. Mm-hmm. So this could be one way of thinking of it. Okay, so I think, can we do the same thing sort of now? So there is this crisis now at some level, at the lower level, at these privately IOUs, there's there's sort of a run happening. Someone or a couple of people want now to transfer these IOUs in sort of more acceptable, higher hierarchical money. And there's sort of there's trouble at these balance sheets because they're unable to fulfill the promise, and they're systemically important. And now there are sort of 3 phases that happens in order for the financial system to transform.
Are there really 3 phases?
Sorry, 3 steps. I'm not sure. Maybe less. Let's see how you.
I guess the way I would explain it is.
How does it work?
The way I would explain it is to say that there is now this pressure from a hierarchically lower instrument to be converted into a hierarchically higher instrument.
Right.
the hierarchically higher instrument could be either already state guaranteed or is gold, so is a commodity money where the shared belief is that this is now safe. And it's just not possible that all the hierarchically lower money is transferred at the same time into hierarchically higher money, because there's just not as much hierarchically higher money, and also because it's not technically feasible to do all of this, right? And then the accommodation is to say, now the state says, okay, no, I also guarantee the hierarchically lower money. And how I guarantee it can be by just nationalizing the issuing institution, or just guaranteeing it in one way or another. And I mean, I guess it's a performative act that probably doesn't change that much effectively, but it's just an expansion of the scope of the state in the monetary system in order to calm down this run. And yeah, so the state says, okay, I guarantee this now, and this is safe, so keep your money that you want to get rid of. And then if that works, and people say, okay, well, now I have the state guaranteed money, then I'm fine with it, then you basically calm the run, because it's just a self-fulfilling prophecy, right? It's all like animal spirits and the market dynamics. But it leads to a substantial transformation of what the role of the state is in the monetary system. The state grabs this new instrument, and then it wouldn't let go again, because why would it? So I mean, now you have all the power, and now you made all this promise, and so then in the longer run you start regulating it. Maybe this is the third phase, then this idea that in the longer run then states have the ability to redesign or shape these newly attained instruments according to whatever they think is a good idea at this point.
Okay, so now this new system is accommodated by the state.
The instrument is accommodated.
The instrument is accommodated. So I guess one question on that would be, so you've gone through crisis, there was a bailout, and the question is, and the instrument is accommodated, is the transformation now destined to stay? I mean, is there a possibility, or have we seen cases in which there was a bailout, it was accommodated, the instrument, but then somehow we then went back to an older version, or is that sort of by implication a new way of doing things?
Yeah, so I guess here's where this analyticism logic comes in, right? I mean, I do not claim that this is a theory that I don't say that it has to be always like this. I say we could imagine cases where the state backstops it and then goes back. We can also imagine cases where the state doesn't decide to backstop, right? So the rationale of the case selection and of framing it this way is that it just explains what instrument the state basically controls today in the monetary system, right? So we have a very unintuitive setup of state money in the monetary system, right? This is just full of path dependencies, like of things that we've inherited from the past and then have normalized, right? If you were to design a state money system from scratch today and you had all the power to do it, you probably wouldn't make it look the way it does, right? And the reason why it looks the way it does is because of those repeated process. That's my argument, right? But again, it doesn't mean that any new instrument needs to be bailed out by the state, and it also doesn't mean that the state cannot decide to let go at some points.
Right. Good. Very well. Okay. Let's go into the cases.
Okay.
You have picked three in different times. You mentioned earlier as focuses on the UK and the US, or perhaps even the global sphere, which is the US financial system. Can you introduce the three cases for us?
Yeah, so I say it's banknotes in the UK in the 18th century, and then also leading into the 19th century, and then it's bank deposits, where the key accommodation moment was the Great Depression in the US in the 1930s. So the second case study is in the US. And the third case study is also in the US, and that's the global financial crisis, where you then had some instruments that were called shadow money, also receive public backstops. The ones that I really look at are money market fund shares and repos. And yeah, so the first story, and so if you look at the main monetary aggregates that we have today, I mean, then the broader, I don't know, M3 at some point was, I think, cancelled and so on. But the logic is, so what are the key monetary instruments? Those are central bank banknotes. Those are central bank reserves, which you can also just call central bank deposits. And the third ones are commercial bank deposits. So it's banknotes and deposits that are usually considered the core forms of money that we have. And then if you broaden it up, then you could bring in instruments such as money market fund shares and repos. And so the two really historical case studies that look further back are seeking to explain how is it that banknotes are public money exclusively issued by central bank, and that then you have this deposit system where the central bank creates reserves and commercial banks can essentially create deposits. And yeah, so those are the first two case studies that basically explain how this came about. And the first one that goes really far back is in the UK, when the UK was the motherland of capitalism, if you want, Industrial Revolution, and this expansion of industry in England was connected to the rise of banknotes as a new financial instruments. And these banknotes were issued not only by the Bank of England, which was the sort of central bank in London at the time, but also by a lot of country banks. And country banks were basically local shops, so like for instance the north of England, and they were able to just create pieces of paper, IOUs, that they would get to their customers and that they then could circulate, and then at some point the customers could come back to this country bank and ask this IOU to be redeemed in Bank of England notes or coins or something. But yeah, so you had a lot of privately issued country bank notes circulating next to Bank of England notes, but Bank of England notes were much more scarce. And you had permanent bankruptcies, I guess, of these country banks, so they would come and go, but not systemically disappear, right? So they were clearly worse than Bank of England notes, but more abundant. And yeah, I think the issuance of these country bank notes was connected to the agricultural cycle, right? So you have like credit creation and repaying over the year with seasons, but then very much so just with regard to setting up industrial value chains that required like pre-financing of production. So yeah, in that sense, the Industrial Revolution came along with new forms of private money creation or shadow money creation. And then the big turning point was in 1797, which was the time of the Napoleonic Wars. And then there were rumors that Napoleon is now sailing over to England and is going to invade the country. And then there was a huge panic, and people had a run on their country bank notes, and then they had a run on the Bank of England. And then the Bank of England introduced the restriction period. And so the restriction, so Bank of England notes still were promises to pay a hierarchically higher instrument, notably gold. And the government then said, okay, we just suspend gold convertibility. So what then really happened is that Bank of England notes were no longer, or lost this. So to me, this gold convertibility is always just a commitment device. They were nevertheless credit money, but the government said, okay, this is not convertible anymore. We just guarantee that this is usable money. And when the war is over, and maybe it's just like a couple of weeks or so, we will reintroduce gold convertibility. And this restriction period at the end of the day didn't last just a couple of months, but I think until the 1820s, so more than 20 years. And in that time, the British populace just got used to also using Bank of England money with a state guarantee rather than this gold convertibility. So, and this is where I argue this was the first instance when like when banknotes were dragged under the control of the state in a way that it wasn't before, out of like an emergency situation with a looming war. And then what happened very importantly is so that then there was a debate going on, I think, for decades, whether or not the issuance of country banknotes or the shadow bank instruments is a good thing or a bad thing. And some said, yeah, it's great, helps like industrial development and it's good for commerce. And the other said, no, it creates a lot of financial instability. So it's basically the same debate that we have today with other instruments in our time, right? But yeah, so early 19th century is debates about this. And then the big watershed moment at the end of the day is the 1844 Bank Charter Act, when they prohibit issuance of country banknotes, and they introduce the note issuing monopoly for the Bank of England. So banknotes can only be issued by the central bank, which I interpret as a long-term consequence of this original accommodation. And this has just created a path dependency for how our monetary system is today, because also today so banknotes are an instrument that is only issued by the central bank. So private banks no longer issue banknotes. You cannot be you cannot open a supermarket in a village and start issuing your own banknote. That is not possible anymore, right? And so this 1844 Bank Charter Act really created the precedent that was then adopted elsewhere. That's why so England was the heart of the capitalist development, but also the center of the global financial system at the time. So the changes that happen there are adopted elsewhere. This legitimizes then also why I look at the UK and the US. But yeah, so it tells the story how banknotes started off as private substitutes that maybe were not even real money. So were these country banknotes really money? I don't think that they really used this terminology that much. It was just circulating credit or something. Yeah, and then in a period over a century, it basically becomes firmly established state money only issued by the central bank.
Right.
That's the first case study. And then the second case study is about bank deposits.
The 1930s now.
Exactly, because the story is once the 1844 Bank Charter Act has taken away the right of banknote issuance from banks and country banks, you still wanted to create your own private credit money, but you couldn't do it with banknotes anymore, so you shifted to a different instrument, which was bank deposits, which bank deposits are not printed sheets of paper. They cannot physically circulate, right? They are actually even an older instrument. They're just the bookkeeping entries of banks and firms. But they are also created through a scope of IOU, so on a certain level of abstraction, the deposits are nothing different than also the banknotes, but their way of circulating is a bit different, right? So you need to...
And to flesh that out, the actors are on the one side everyday people like you and I, and the bank, two private.
Yeah, but just like with banknotes as well.
Of course. I just now wanted to.
Yeah. So what happens?
Yeah.
What happens after 1844 in the UK is that now bank deposits become the new private credit money instrument, and they're also not called money in the first place. They talk about, typically you talk about bank credit, but yeah, you can trace the second half of the 19th century is really building up payment networks with bank deposits in the UK, and then I also worked a bit on Germany. So you see how with the creation of the German Empire in 1870, they create the Reichsbank, and they also say, we want to now modernize our monetary system, and they now want to create like an integrated deposit-based payment system. And also the US does it, right, in the late 19th century. So building that up, but the US is still the latecomer there. But then the First World War happens, and then which is a story of the shift of the center of the global financial system from the UK to the US, gradually over some time, but
interwar period,
exactly. And in the interwar period, as you say, this is when the Great Depression happens. You have the 29 crash, and then you have, in particular, the 29 crash in the US, right? And then you have 3 years or a 3 year long recurring period of bank runs from 1930 to 1933.
Just before that, we established what the bank deposits were, which is just another way of what was priorly done on the banknotes, but it was differently handled. But then this arguably just became very, very big. A lot of people used it, and it was just
because it's much easier, right? If I can, I mean, so you can say, oh, maybe it's better to have the printed banknote in your wallet and be able to make a payment with that. But once you just have a deposit system where you just record orders, oh, I transfer 50 pounds to you, but you transfer 30 pounds to that person, and then so on, then you just need to record those instructions, but then you can net them out, and at the end of the day you can have a much higher complexity of payments, and then also allow a much higher division of labor and much more consumption if you actually operate your payment system like that. So
right.
In that sense, the printed banknotes were also a bit more cumbersome, right? So
it was huge, and also as a step before that, there was enough precedent, there was enough trust by the users that if I wanted to get my money back, I have a deposit, I get the deposit, and I go to the bank, and I want now, let's say, in this case, I don't know, pounds, or in whichever country we're right now in, there was enough precedent that there was no problem to get it into...
Well, for this we have to be in the UK and look again at this 1844 Bank Charter Act, because what the Bank Charter Act did was separate the Bank of England into two departments: the issue department, which would issue banknotes as a liability, and then the banking department, which would issue deposits as a liability. So this is where you get the logic that the central bank is note issuing and basically reserve issuing, right? And then you have the private banking system, which uses the Bank of England again as the hierarchically highest institution, where you could exchange your private bank deposits into reserves or banknotes if you wanted to. So the banknotes get established as the hierarchically higher instrument, as a relic of the 18th century system where banknotes were also private money. But now there's the central bank monopoly, and you have a much lower volume of banknotes. But you sort of get a parallel system where you can use notes, but there's not so many of them, and they're also maybe more cumbersome. And if you want to really have complex payment chains, why not just take the book money, which is deposits?
So bank deposit as they emerged, a change value check, you can transfer, you can easily get them into accepted means of payments, pounds in our example, and it becomes very, very big and systemically relevant. So we have 3 checks, and then there's a crisis, and then what happens?
Yeah, so the thing spreads internationally, and then the crisis happens in the US. So this is not a jump country, and there in the Great Depression, there was no immediate state interaction, right? So there's a lot of literature about it, how it worked and why it took so long. But I think one story is that the Fed was the structure of the Fed. There was the New York Fed, which was privately run, sort of, and then there was the DC headquarters, which with political appointees. And the Fed as an institution is only operational when both the New York Fed and the DC board can agree on something, and they couldn't agree on what to do in the early 30s. So, and then what you have is 3 waves of banking crisis that are all escalating, where you just have runs of depositors that want to get their deposits converted into banknotes, and the bank branch doesn't have so many banknotes. At some point, the bank needs to close down, and I think the third run, then I mean the whole system is still stabilized by the Bank of England, but I think in 32 or something, the Bank of England then disorderly gets off the gold standard, so then the international monetary system implodes basically. And then there's a change of government in the US, and the new president is Franklin Delano Roosevelt, and one of the first things he does when he's in office is he gives a talk, I think we call it fireside chat, on the radio, where he says, folks, I want to talk to you about money and banking, and I hereby guarantee all your deposits. So don't queue up anymore in front of the bank branches, just keep your deposits, your money is safe. The new government backstops it. And again, this is where you can say this is the performative act when he first announced this accommodation, and then I think it was followed by an Emergency Banking Act, and then I think there were 2 other banking acts that basically further established this logic of how the guarantee works. But yeah, what they did is they then established the federal deposit insurance in the US. So from now on, bank deposits get insured. The way this is done is that in good times, the banks have to pay in some money into the fund, but then yeah, you have a new institution, we would call it an off-balance sheet fiscal agency in this group, that now manages the guarantee of the deposit system. And so this is not the same type of accommodation as with the banknotes, because they didn't nationalize the banks. There was the Chicago plan at the time, which would have been basically exactly that. Just get rid of private deposit money creation and just do it like they did it with the banknotes in 1844 also, right? Just only the central bank is allowed to issue money and the banks shouldn't do that, but so that they opted against that. So it remained possible for banks to endogenously create deposits the way they wanted to, but also not entirely the way they wanted to, because they were heavily regulated, right? There was then the Glass-Steagall Act came in, that separated the deposit banking from investment banking, which would shape the US financial system for the 20th century. And well, they had deposit insurance now as a new regulation to make sure that these bank runs would not reappear. Yeah, and that is basically the story of the second big private credit money accommodation, and how it happened that the state now creates a regime where it's sort of the way of this 2-tier banking system where banks can still create money, but only under certain circumstances, and the state supervises it and controls it to some extent.
And when I listen to you describe what happened, it's in certain ways this is still how banks operate in a way, that they retained.
This is just so that's what I say. So the thesis actually wants to explain why does our monetary system today look as weird as it does.
And it does because it's how it had evolved, how it has transformed in sort of a build-up phase, and then how it was accommodated. That accommodation we can clearly see still today.
Yeah, so those are political decision under high time pressure and uncertainty, how you do it and not, and then the whole thing gets normalized, and then we call these instruments like state money, and we maybe tend to forget how the state started controlling them in the first place. But yeah, so it's really those moments of the crisis when there's the real state power coming in, and when they can shape it and backstop it.
Yeah, I mean, we haven't talked about it yet, but when the state comes in, and because you just mentioned also there is a crisis, there's also of course. At what price does the state buy in, so to say? Or there is this, I think, phrase that Badgett has coined in his Lombard Street. I believe I believe that he coined it there in 1873, where he writes, "You should, in a time of crisis, the public interest or so should come in and lend against good collateral at high interest." And that is it true to understand this sort of approach to crises in which we've discussed, for example, in the 1930s, that you don't bail out everyone, or there's sort of a price to be paid, and you do it that way. Can you talk?
Yeah, but I think
if it's correct, and if
no,
not,
it
how
is
do you
correct.
see
But
it?
I think so. In the way how I would think about the evolution of the monetary system, I would say what Badgett describes in the 1870s is after the 1844 Bank Charter Act, right? So it basically specifies the relationship between the central bank, so the Bank of England, and the banking system in a deposit-based system. So so it actually shows coming of age, if you want, so reflexivity, I don't know, of monetary thought, that, what we have now designed, maybe more by accident, is a 2-tiered system where, you let the banks hand out loans and create credit, and then you have the Bank of England, which now should establish a consciousness that is actually the lender of last resort, that sort of supports it by acting counter-cyclically in order to avoid the deposit banking system to blow up, right? And then what happens in the 1930s in the Great Depression is that this precisely doesn't happen. So I mean, because the Fed was blocked, so that's why you had these bank runs further down in the hierarchy. So because they didn't follow budget, then it became actually necessary to also accommodate banknotes by guaranteeing them and really turning banks into public-private institutions, if you want, and then also introducing deposit insurance and all that jazz.
Are you referencing also now, or are you trying to also talk a little bit about when the government should step in a way? Did I understand you correctly that it matters also when it steps in? Is maybe earlier better than later, or have we seen more later because that's really the only way that...
I'm not sure that in budget the central bank is really the government, right? I mean, it's really right. The central bankers are also just appointed London bankers, right? So I guess this is always this hybrid game there. So that is the first point. And the second point, this is not a normative theory. I do not say how it would be correct or incorrect to behave. It's really an attempt, as I keep on saying, to reconstruct how it is that the monetary system, the way it does, and what role the states played in it, and if the state was really able to rule by decree that an instrument X should be money or not, and the story is no.
Can you talk a little bit about the cases? So
the third case then.
Well, yeah, I was gonna. If you
I mean, that would complete the story, sort of, to say that.
Let's do that.
That the global financial crisis of 2007-9 replicates, again on some level of abstraction, what happened before to banknotes and bank deposits. And the story is that then in the US you have the highly regulated system after the Great Depression with the Glass-Steagall Act, and bank deposits are only allowed to be created by regulated commercial banks within very narrow limits, right? So they cannot expand their balance sheet too much. They're not allowed to issue too much, to pay too much interest, and so on. And so at some point there's a development that you then say, maybe why don't we create new instruments privately that substitute these deposits? And you can see this in various ways. One thing is that you introduce these money market funds that reproduce what banks do in some way or another, but are not regulated as banks, but are regulated by the SEC, I guess. And then you have the story of dealers that issue repos, and these repos are but also promises to pay deposits in some way, right? So this is now all what Perry Merling talks about in his MOOC, and the story of the rise of shadow banking. And the third big instrument that I also look at in the thesis are asset-backed commercial papers, which are the liabilities of banks' SPVs. So the bank cannot create more deposits on its balance sheet, but it can create a special purpose vehicle, maybe in the US, maybe in some offshore center, and put certain financial activity there and not call it deposits anymore. But yes, this is now the creation of an asset-backed commercial paper. So we enter into the world of alphabet soups of financial instruments where most people completely lose the overview. But I guess the point is simply that you invent new instruments that you make sound fancy and look complicated. You create like a bit of a legal story around it, but at the end of the day you just it's a form of private credit money creation, of private credit creation outside of the established regulated system. And then some of these instruments will start trading at par. So you promise a constant net asset value for money market fund shares. That's just the establishment of par. Or you have repos that are so short term that they overnight they also trade at par. And also these asset-backed commercial papers almost traded at par. And the idea is that then in the early 2000s you basically have a lot of, so in the early 2000s the mindset is that the old deposit banking system is hopelessly outdated and unprofitable. And I mean, in the 90s they even killed the Glass-Steagall Act because they said, so the old regulated banking system cannot keep up with all those new financial structures. And there's a lot of financial expansion going on. And the whole thing flips, reaches the Minsky moment, as you sometimes call it, then when there is a bursting of a real estate bubble, and then you realize that much of the in particular on the repo market, you realize that the repo collateral that you use is actually not based on safe securities, but is actually based on pretty shaky securities, and then you don't want to continue doing all these processes. And then, yeah, again, on a high level of abstraction, you have de facto runs on these shadow money instruments, not in the sense that people queue up in front of bank branches, so it's not that physical, but it's in a globalized financial market where you just stop wanting to accept the new hierarchically lower instruments that have been developed. The old traditional banking system, which was uncool before, suddenly everybody wants that. And yeah, that turns into a huge run on the shadow bank system, basically.
But just to, and I think that's helpful, and to see sort of the matrix will probably help understand. But just to start on a very individual level, so it's these where an individual would have gone earlier to a bank and have a deposit at the bank, with their money there, they would now have it at a money market mutual fund.
For instance, yeah.
For instance. And this is sort of another of these exchange of IOUs where you would transfer from the deposit to the money market, to the money market mutual fund, and it would be then there that you have talked about the par relationship had been established. That means at any point in time there was enough precedent and trust there that these individuals and on this strand would get, if they needed to, the money out of the money market mutual fund and then use it maybe to buy something.
Yeah, but that's the same type of guarantee that the English country bank in the 18th century would give, that its notes trade at par with.
It was a private.
It's a private guarantee, and it probably works unless everybody really tests it at once.
Right.
And well, then it cannot work anymore.
And I think that's just for at least I think worthwhile to flesh out that. And then there's a whole branch of transactions that are happening from the money market mutual funds into then, for example, financing real estate. Some of them, as you just mentioned, were shaky in how they were in reality promises to ever be paid back.
Mm-hmm.
But the point is that these are all sort of unregulated. They have been established through the private actors, and in the beginning they had a certain size, but they became bigger and bigger. You had the establishment of par, and then sort of became systemically relevant, as we saw, sort of again going through your theory into the first three phases into we reached the so-called Minsky moment, that these were all there, check, and sort of then it unravels, and that's to the build-up. Okay, I think that's helpful, and there's so much more to go into because this is a fascinating story, I think, on what and how this built up, but this theory I think helps to how it develops, because you can always read on, okay, this happened, but the question is, what is sort of the way into it? And I think these three steps make it very, very sort of, there is first a private relationship, and it sort of gets bigger and bigger, and the getting bigger and bigger is really the driver here, perhaps, as well. I want to ask you about the cases. There's obviously, when you look at these three cases, they're like super important, but there's many cases. So can you talk a little bit about case selection? So is there one that you would have maybe done, you didn't, you at some point you have to make a cut? Are these the three most ideal? Just a little bit how you went.
Well, I looked at the monetary system today. I mean, it's what instruments do we use as public money today? And it was backwards inducing, right? So in that sense, you can say there could also have been cases of instruments that we maybe forgot that were important at some point, but then got into a crisis and were never rescued. So I didn't look at those, or maybe there were even forms of private credit money that never became systemically relevant. I guess that there's a lot of financial innovation going on, but the case selection in this particular case, because it's the attempt to ex post reconstruct how the system today looks and unveil this idealized process. Yeah, so this is the rationale for the case selection.
Would you have, if you had the time or the resources, did you leave one or two out that you would have wanted to add? maybe
I
smaller?
mean, in the case study of the global financial crisis, I mean, there's basically one negative case involved. Those are these asset-backed commercial papers because they did not get backstopped. So the Fed basically facilitated at the beginning of the crisis that the losses had to be swallowed by banks that sponsored those special purpose vehicles. So yeah, we did not see an accommodation of asset-backed commercial papers. So this is something that I looked at. But then, yeah, I'm sure if you look at other countries and other crises, because these crises happen all the time, right? I'm sure you could find other instruments, but I am not aware of a very important case that I didn't look at that would have been very important for the general story.
On cases, I just had one more question. That is, cases that didn't behave to your theory, and I was wondering maybe the asset-backed commercial paper, was that something which had, because I guess one of the things in your theory where you're not putting directly a measurement on is of what is systemically relevant.
Yeah, because I think you can't, right? I mean, it's an opinion. I mean,
right. And so when I'm asking the question, or myself asking the question, cases that didn't behave to your theory, then it's hard to answer that question to begin with, because it's hard to assess whether it was systemic relevant or not. I guess that's the way to look at it, right?
Yeah, but I guess we come back here to methodology, right? So I mean, I guess this idea to say you need to look at negative cases and
right.
to really be sure if the story that you tell, if there's an underlying causality or so on, this is how you would approach it in a positivist framework, right? And
okay.
This is where I would come back to this analyticism. The idea is to uncarve ideal, typical dynamics, processes, and use them as an explanatory, interpretivist frame to make sense of the real world. And I think it's very useful because it helps us understand why the monetary system looks the way it does. It gives us maybe a high-level interpretation of the global financial crisis, what actually was going on there, and why this is not so unique as maybe some would say. How there's an underlying continuous evolution of the monetary system that grants a new role and new powers to the state. The state is a latecomer, right? So all these things that I keep on emphasizing. But yeah, it is not like a causal story of, I don't know, the research question could be under which conditions, or why is it that the state accommodates the private credit money instruments or so. And in that case, you would really need to have negative cases, and you would need to build a data set with as large n as possible to then tackle these questions, which you can tackle. There's nothing wrong with them, right? So again, it just comes back to the nature of the question that you want to ask, and then the methodology that you take.
And I think you already mentioned it earlier that of course your reference point is how it is today, and that's sort of how you.
That is the motivation, yes.
Yeah, but also that's how you can pick the cases.
Exactly.
Because when you have an accommodation, but it's not today, then you don't look at that case. Perhaps that would be an interesting one to look at. But definitely those that didn't transfer into reality today, you don't have to look at. Yeah, that's interesting with the framework of analyticism. Let's go into conclusion.
Yeah.
You talk about sort of what you call sort of a functionalist understanding, and just in my own terms, when I read through it, I understood it to be perhaps, and you write that it should be it could be perhaps a new approach, and you can tell me how you've written about it, but I understood it to be a little bit like almost like an epistemological branch alongside realism and structuralism and the others, interpretivism or constructivism, that you say maybe there is something or not. Is that a right way of putting the question? I would be interested if not. And is it also to say that you say functionalist understanding, what it means is there are certain technicalities that work in a certain way. So there is these, for example, these IUs that these two parties have with each other. And there's a certain functional technical aspect of it in which it works, and therefore it sort of shines into how things are transforming, evolving, name it as you wish.
Yeah, so the So the term functionalism, I think, is actually a form of an academic insult. So I think there was a reviewer at some point who sort of criticized me on saying that, but your approach is not really looking at individual actors and is not looking at interests or power, which are usually the things that the political scientists or the political economists want. And they say this is just a functionalist explanation, which means, you don't zoom really in. But I think I just didn't understand that it was an insult at the time, so I just said, okay, if you want to call it functionalism, then I just take it on board. So probably today I wouldn't use it anymore this way how I did it in the thesis. I would rather say that it tries to be on a system. It's a systems theory at the end of the day, right? So the system is based on endogenous credit creation. There's a clear incentive for private financial entrepreneurs to come up with new instruments. There will always be the situation that at some point the whole thing flips, and the question is if the whole credit system shrinks or if somebody comes in as the deus ex machina and backstops it. And on that level of analysis, I don't care too much who the person was that ultimately made the decision and how it, so to bail out or to do financial innovation or and I do not care too much what was the belief system and what was the interest. But I say that, so the idea that I had with this entire thesis is to say, hey, it's a complex system, this web of interlocking balance sheets. We can study dynamics that are going on in there, and there's a certain systems logic to it. And then the individual actor who is put into a certain position is confronted with the dilemma structures that the system produces, and then they have to act like this. Maybe they don't do it right away, like in the Great Depression, where it took them 3 years to actually then guarantee it, right? But the system creates this pressure, and at some point somebody has to do it, and so that's why the whole thing does not attribute too much importance to individual actors and or networks of actors and what they believe and so on, but it says it's a systems logic. And I think one review at some point said this isn't a functionalist logic, and I said, well, maybe it is. I use this label here.
So thank you for having, I think around 2 hours we spent on your upbringing, sort of leading into, but mostly on the thesis that you've written. And I think for the end, let's take a bit of time and talk about your current work. Why don't I give you a chance to talk about the Global Climate Forum, what it does, and specifically your OBFA, what does it stand for, and what's sort of the core of why you're getting funded in this interesting project.
Okay, thanks. So I'm currently leading a research group, which is founded by the German Research Foundation, Deutsche Forschungsgemeinschaft, in a program that is called Eminöter-Programm, which means that you get 3 + 3 years, so 6 years in total, in which you can choose a host institution in Germany and carry out a research project that sort of follows your academic trajectory, and they like to give it to people who have spent a considerable time abroad and then learn something abroad and want to bring it back to Germany and build up like a new subfield maybe based on their ideas. And this applies quite well to me. So I did the PhD in London, and then I spent a couple of years in the US doing postdocs, and the PhD was on this theory of private credit money accommodation, and the postdocs I then worked on the European Monetary Union, which is what I started out with, as we mentioned earlier in this conversation, and I worked on the international monetary system. So I still published some papers on those topics. But then as the next step, I had this idea, I saw these options for these bottom-up funding grants, and I thought this is quite interesting. And the idea for the project that I wanted to carry out was to look at large-scale transformations and how states can finance them. So it goes a bit beyond this private credit money accommodation theory, but it's in the same mindset, sort of, right? So we have a largely privatized credit money system. The state is a latecomer in there. The state doesn't control money in a way as it's often pretended, right? And yet there are these phases when the state really wants to bring about a large-scale transformation. So really wants to do huge investment projects, and how does it finance it in a system where money is mainly endogenously created? And the cases that we look at there in the group, so that the hook is how can we finance decarbonization, right? So that's we say we live in a system, an industrial system that is based on producing high carbon emissions, and we would actually need to revamp our capital stock to reduce carbon emissions, and this will require just a lot of money to do this financing, and it's a politically desired project, so somehow the state would need to be able to do it, and it's just not happening, right? So maybe because there's a lack of understanding of state capacity to actually carry out large investment projects. And the entire project is designed in such a way that we say, well, why don't we look at how this has been done in the past? And so in the past, nothing similar happened like decarbonization, right? But what we can look at is other state-led transformations, and the big examples we picked are war finance and reconstruction finance. So when states need to finance wars, this is usually the point in time when anything goes, or when you overcome obstacles, and when you also do financial innovations, when to set up new structures for states so that they can actually generate a lot of funding. And then the other big example is development finance. So for instance, reconstruction after wars, which also is a situation when the private sector maybe doesn't work that well, and you basically need state interventions. And yeah, so at the moment we're just about to hit the 2-year mark of the project. So the first third is done, and we have been carrying out a bunch of case studies now, or still working on them, on war and reconstruction finance in Germany, the UK, and the US in the 20th century mainly, but we're also publishing on questions of decarbonization. And now, what is our assumption how states do this? And this is where the concept of off-balance sheet fiscal agencies comes in, OBFA. So, and this is a neologism that follows also from a view on the world as a web of interlocking balance sheets. And the question is, where actually is the state in these webs of interlocking balance sheets? And the typical way of approaching it is to say the state has 2 balance sheets. One is the treasury, the core budget, and the other is the central bank. Maybe the central bank is even hybrid, as we said, but still it's somehow, most people would agree it's somehow a state institution, even if it's maybe privately owned in some cases. Yes, and so if the state uses the central bank to achieve something, you would usually call it monetary policy, and if the state uses the core budget to do something, you would call it fiscal policy. And so the way, if you're a good economist, you think about the world as well. We need the mix of monetary and fiscal policy. And now the project says maybe this does not provide the full picture, because what tends to happen very often is that states just create new balance sheets that are neither the central bank nor the treasury, that do not sit well within the monetary fiscal dichotomy, and they put financial activities on these new balance sheets. And so the umbrella term for these new balance sheets is off-balance sheet fiscal agency, because it's somehow the state that does something there, but not in the way how we imagine fiscal policy to usually happen. And this ties in quite nicely with the PhD thesis, because the PhD thesis talks about shadow banking, financial innovations, new balance sheets coming up, possibly new instruments coming up, right? And it traces, the PhD thesis traces how this has been done by the private sector to generate new instruments, which then end up as the public money we have today. And this now looks more at the state in the driver's seat, maybe not leading to new forms of money, but nevertheless what the state does is it creates all sorts of special purpose vehicles, if you want, that can be designed in a multiplicity of ways to put financial activity there, and then maybe create a new dynamic of credit expansion with the help of these new balance sheets. And so the assumption is that if we look at how the big states have financed their wars and the reconstruction, we will find that what they actually did is they created new state balance sheets, new OBFAs, and let them do a lot of the work, like put credit creation on them, and then make it possible to generate new financial capacity with the help of these vehicles. And in some way you can call this the shadow banking of the state, if you want, because it's not so different from what actually banks did when they created SPVs. And the idea then is to say that the state is a much more complex financial being than just the entity that controls the core budget and the central bank, because in fact there is also, just if we look at the fiscal ecosystem, so the combination of the treasury and all the OBFAs, we see again a long path dependency reaching over probably centuries in various states, that they just build a new institution to solve a certain problem, maybe to finance some transformation that they want to finance, and then this institution stays there. And so the complexity and opacity of the fiscal ecosystem increases and increases further. But it is connected to the desire that the state wants to be entrepreneurial and to somehow finance a transformation, in particular war finance. And that's why the project is called OBFA-TRANSFORM. That's the acronym we've chosen. I guess the full title would be the Political Economy of Financing Large-Scale Transformations of Balance Sheet Fiscal Agencies in Wars, Reconstruction, and the Green Transition. That's the project title. And the Global Climate Forum here in Berlin is our host institution. So this is a non-university research institution where they have offered us like a space to build up this project and carry out this research, which again I think is my old situation, that it just doesn't sit well within the established departmental structures. So is this political science, is this economics, is this finance, is this history? So it's actually truly interdisciplinary, if you want, but also and has its own methodology in some sense, which I can defend and legitimize, but still it's maybe not necessarily what you would do as the mainstream type of research at those departments. But
there's still the Fire University of Berlin still has a role in this.
Exactly. So the group collaborates with Free University. So I'm teaching at Free University. PhD students can be at Free University. So the way it is designed is that you have this university collaboration, but it's also with the John F. Kennedy Institute, which is also a bit more of a interdisciplinary research center in Berlin.
So just listening to you speak about the research project, and you just referenced it yourself, going back to your PhD, is it fair to say, or how would it sit with you when I say that there is within a credit-based theory approach, you have both the state-based and the market-based, and we've established like MMT being a state-based approach to this, and Money View being a market-based. Is it to say that an OBFA approach, that it is, number one, it is a credit-based way of thinking about it, and would you say it is therefore, because the state is doing it, an alternative to MMT, an approach, and how would that in theory, or the theoretical base of that look like?
I mean, I think the OBFA concept fits perfectly well to a market-based credit theory of money, because this is still it's almost a logical question with the market or state-based. So what comes first, right?
Right.
So it doesn't say that the state doesn't play a role. Of course the state plays a role. It's just not that the state is in the position to establish by decree what money is, right? So this comes more from endogenous processes, but still the state is crucial in backstopping it, maybe also in supporting the evolution of it, right? The state transforms further as an entity with the evolution of new credit instruments and the unfolding of the credit money system. So yeah, the state clearly plays a role, but the state is not in the driver's seat, but is a latecomer, and also is maybe a bit on the defense with regard to the private sector. So the logic of OBFAs is that because the state doesn't control everything and cannot do everything and do not do top-down ruling, the state has to find ways to interact with the system in a bit smarter and maybe ways, and maybe use gray areas, and that's why there is a constant tendency, that's what I would argue, for the state to actually come up with these new hybrid vehicles that take over functions that we usually associate with the state, but they're just not run through the core budget of the central bank.
But just coming back to the point, you would put that rather in, if you were to clearly, if it's even possible, you would rather put it sort of as a state acting as, if you say it's state acting as an entrepreneur, sort of in the market-based category, than in a state-based category.
Because I mean the one thing is so this diagram with the state-based versus market-based theories is on a different logical level. It's about what is our theory of the monetary system.
Right.
So, and I'm pretty clear that it's a market-based credit theory of money.
Right.
But then the state has to operate within that, and then I can investigate empirical phenomena or certain processes again, and try to make sense of them. And this logic that states, when they want to finance large-scale transformations, tend to come up with new balance sheets on which they put financial activity, fits very well into that view of the world, right? It's I guess another idea of how to investigate what's going on in the web of interlocking balance sheets and how it changes over time. And yeah, it's maybe to some extent it's the same as what the PhD thesis did. It's the idea of a phenomenon that you can then identify in different periods of time and in different places.
Great, I love it. That's definitely very interesting. So I think just putting my own words, but it would be interesting to hear if you disagree on how we would put it. The need for these OBFAs to come up synonymous with war is that there needs to be a sudden change that is sort of needed, or that is imperative, and it somehow doesn't work entirely by the private or bottom up doing it on their own, and therefore there's this impetus that comes through the state, and that's why we have these war finance, or in this case these OBFAs helping to do the green transformation.
Again, I would tend to say that this is not a normative, so it has to happen. So there's no normative dimension of it. It's more like an analytical dimension when we look at war finance. How has it happened historically? So when you feel under attack, then this is when maybe more policy space emerges. Then like old taboos can be broken. Then things are possible that were not possible before. Then the opposition will tend to rally behind the government, and then you can actually make much more substantive changes to establish political structure and also financial structures. So that's why I guess the war is just a very big driving force, for better or worse, that leads to transformations of technology, but also the financial system. And the analogy to the green transition is a bit, I mean, I think that there are some scholars who compare the green transition to war finance. I guess war finance, in particular in the US context, also has a very positive connotation, and it's just more symbolizing a more active state in the financial system. I guess in the German discourse you do not have such a positive connotation of war finance usually. But I think that so my idea for the project is to say, let us use the market-based credit theory of money and develop a better understanding of how states actually can finance or have financed large-scale transformation. So it's basically an act of theory building. So look at historical cases, build a theory, and then with this new theory think, are there maybe ways of being more effective in financing decarbonization? If this is something we have agreed upon as a social goal, that it would be desirable to just emit less, but somehow we constantly don't manage to achieve this. And if we look at a global scale, carbon emissions go up and up and up, right? So somehow, yeah, even though there are these, it's quite present in the discourse. Maybe not that much now, but it's coming. It's a recurring theme, right? And it is a problem of global proportions, and somehow we don't seem to be able to steer our financial systems in a way that it actually does what we think is needed. And yeah, so I guess the idea would be, can't we get better theories of how you can actually finance large-scale transformations as a state?
Thank you. I think that was an important clarification, specifically to the normative aspect that you made clear. It isn't. You said you were 2 years within this funding, and I've seen that you have already published a lot of research. I think saw some on the rearmament. So using OBFAs in historical context, and how were they used for war finance or the development phase after the war, for example. And I think I remember the rearmament. I think you looked in the 1930s, and then in the German Democratic Republic, the development. And I think you recently went also to South Africa, which you haven't yet published anything on. Do you want to elaborate a little bit on these cases and what you found?
Yeah, so most of the stuff is still work in progress, so there's only a very limited amount of research that we've been doing that is published so far, and if it's published, we first usually publish it as working papers and then later as peer-reviewed articles. We are picking institutions that we identify as relevant off-balance sheet fiscal agencies and try to understand what they actually did, so what were the financial mechanisms that they implemented in order to finance transformation, to kickstart credit creation process. And yeah, in Germany we are currently doing a case study on the Kreditanstalt für Wiederaufbau, the KfW, the largest development bank for post-war reconstruction, so founded after the end of the Second World War. And then the one study that we have basically completed already is the war finance. So actually, it's not really war finance, so it's a question. So the rearmament financing of the Nazis before the Second World War started, from 1933 to 38, when they used a very specific scheme that is called the Mefo. Mefo stands for Metallurgische Forschungsgesellschaft, so which was a letterbox company founded by 5 big German industrial companies, including Siemens, I think, ThyssenKrupp, and so on, which was a letterbox company that issued bills of exchange or quasi bills of exchange on behalf of the government to secretly finance, so kickstart a financing process for rearmament in 1933, at a time when Germany was not allowed to do this due to the Treaty of Versailles, and when the international monetary system had just collapsed. I mean, that was in parallel to when 33, this is when Roosevelt accommodated bank deposits, right? So it's the process going on in a different country that had its own, like with a new government that had its own strategies and wanted to secretly rearm in a very defensive position, because shortly before that, when they tried to do something, Western Germany was still occupied by French forces, I think, with the Ruhr occupation, right, when they didn't want to pay back their reparations debt, so they didn't really comply with the Treaty of Versailles, so they were actually in a very defensive position, difficult position, and so they came up with an OBFA scheme to secretly finance rearmament in a situation when the international monetary system wasn't working, when the German banking system was also still very much affected by the Great Depression. And yeah, this is a scheme that was usually credited to Hjalmar Schacht, like one of the big German financiers, who just before the Nazis started the war resigned from his role as Reichsbank president. And then in the Nuremberg trials, they said he was not guilty, so he survived the trials, and then had quite some influence on shaping the narratives ex post of what this Mefo operation was. And yeah, so we because this is somehow an infamous story, right? And sometimes called financial wizardry, and so we had this idea, why don't we try to use balance sheet methodology to actually just explain and reconstruct what happened then. And that is online at the moment as a working paper also.
Yeah, I saw that. can you talk about what you're learning from this? I mean, is there something when you think about today, and we talked about the decarbonization question, and maybe also put that in perspective with currently there's a law in process to I think so today Monday is we have Monday the 17th. I think tomorrow the lower house here in Germany, and then on Friday the upper house is supposedly to
Let's see what happens. Yes,
let's see what happens.
It could be a watershed moment in the German macro-financial history, arguably. Yeah.
500 billion euros. The question is sort of what have you learned with the OBFAs? Now they talk about it, sort of a Sondervermögen, sort of a special vehicle. Is that synonymous with what an OBFA is? How does it relate? Maybe just your reaction to it.
Yeah, so we also published a paper in which we try to operationalize a bit more in the German context how we define OBFAs. And there's not one clear-cut distinction or definition of them, so we say there must be actually there's a spectrum. And these Sondervermögen, special funds, we count them as an off-balance sheet fiscal agencies, but they are as close to the core budget as it gets. So those are, you can say, separated balance sheets or like entities, if you want, separated from the core budget that allow stretching the expenditure over several years, whereas the core budget you have to spend everything within a year. Some of these Sondervermögen have the right to issue their own debt, but the debt would still be equivalent to German government debt, and everything that's happening in a Sondervermögen is subject to the German constitutional debt break, unless you then write in the constitution that it doesn't count to the debt break. So this is sort of the workaround they find at the moment, right? So Germany has this debt break. They're saying we should not issue more debt than, just a very, very limited amount of new debt. Should be very difficult. But then, since the Russian attack on Ukraine, they started introducing a new way of circumventing it, which means you create a Sondervermögen and then you exclude it explicitly from the debt break. And it fits very well to this idea that when the state needs to do something, in particular in the case of wars, they will try to find OBFAs to do this. Something similar is happening on the European level, where they're discussing whether there should be a European rearmament bank or something. So a development bank is also an OBFA in our definition, but further away on the spectrum from the core budget. So that's a separate institution with its own building, a really independent balance sheet. They issue their own forms of debt probably, but there will probably still be guarantees from the core budget to the development bank. And so in that sense, the idea to create a rearmament bank would also fit into this OBFA logic. And then other approaches would be to also just create a private sector entity that is just owned by the state, for instance, and then takes over certain activities. So that this would also fall into the OBFA spectrum, right? So it's just the OBFA is the attempt to operationalize this idea of hybridity. So it's really difficult to find, or it's not so easy to find balance sheets that are fully private and do not actually have a connection to the state at all.
So I'm wondering, because you just mentioned that these Sondervermögen or these special funds that you mentioned are very close to the budget, and therefore in a way they are almost like, not entirely, but like a budget. And in a way it's just, there's more debt that's being put on the state in this case. And so my question comes, have you come across, so there's some literature on war finance where they make a difference between either you borrow the money in order to buy XYZ, or you raise the taxes for that. And I think some of so on this change, I think some of the literature says that if there's not enough backing by the population, it's just politically more feasible to borrow money, just because you can't do it without taking anything right away from someone. How do you think about this split, as your research focus is on sort of the borrowing side of it, or does it matter at all?
So so often when it comes to war finance, what scholars tend to use is what we call the triad model, where they say wars can either be financed through taxes, through borrowing on the treasury balance sheet, or through money creation on the central bank balance sheet.
Nice.
And the framing is that this that this triad approach doesn't really work out because it neglects OBFAs, and a lot of financial activity that OBFAs carry out just don't sit well with this traditional idea that it could only be central bank money creation, taxation, or government debt issuance.
How I came across this is the question of war finance, and in the literature there makes a distinction in how to finance it, and sort of, you know, you're more on the borrowing side or you're more on the tax side. Can you elaborate on that, and how does OBFAs fit in this?
So my interpretation of this classical story. So the classical story is that wars can be financed either through central bank money creation, through taxation, or through government borrowing, which means the issuance of government debt. This, in my understanding, focuses mainly on the two core balance sheets that we associate with the states, which is the core budget and the central bank. And institutionally, what you can do is you can actually shift the activity to other balance sheets that then take over financial activity. So if you create a special bank that finds ways for financial activities to provide war finance, then this just doesn't sit well with this traditional triad model. So if we talk, okay, it's maybe easier to talk about this example with the Mefo bills. So what the Mefo was, it was a private company, so run by 5 big German corporations that issued bills of exchange, so not in the sense classical government debt. And these bills of exchange were then given to the central bank, which discounted them, but then also passed them on to another OBFA that acted as market maker. So it was actually a very complex financial structure that was not simply issuing government debt, right? What you can see that at the end, ex post, these Mefo bills ended up on the balance sheet of the central bank. And then you could say, ex post, it maybe looks like this war got financed through, or the rearmament got financed through central bank money creation, but it's actually a very simplistic ex post rationalization, because it wasn't the case that the central bank just printed money to pay for it, but there was a very complex operation going on. And the original idea, according to Schacht, was actually that these Mefo bills should be translated into government debt, and then ex post you could have said, well, they financed it through government borrowing, but again, which is not true, because they used this camouflage commercial bill mechanism. So yeah, so I just think that this triad model of just taxation, government borrowing, or central bank money creation is just way too simplistic to understand how the financing process actually works if you want to finance large scale transformations in the context of war finance.
Right. Thank you very much, Steffen. I think those who are interested to hear more about this or read more about this, you have a paper out on that and others in English and German. And thank you for taking the time to talk to me.
Thank you for your initiative to do this video and for asking these great questions. Thank you.